Okay? We'll cover technical analysis. Okay. So the next form of the efficient market is the semi-strong form. So now we're going to broaden our definition out a little bit, and we're going to say that the strong form asserts that security prices adjust rapidly to the release of all public information. All public information. Okay? Therefore, current security prices reflect all information that is available to the public, and this includes the security market information, prices and volumes that we looked at before, and public information on non-market items like company earnings and dividends, okay, as well as economic and political news. All right? So if you believe the market is semi-strong efficient, then it means that investors who base trading decisions on news, any news, after the news is released, will not consistently earn superior returns because security prices adjust far too rapidly. Okay? Studies, and we'll look at some studies on the next slide, indicate that the market may not be semi-strong efficient. Okay, so let's look at it. So let's take just a brief pause here, and let's make sure that we don't go too far. So we're in chapter 8, and oh, we've gone too far. We've gone too far. Okay, that's okay. We'll continue on, and we'll edit a little bit. We're supposed to go, we're supposed to stop at 4, and we'll go 5 through 10, and then 11 through 16. So you guys stop me, okay? Let's see where we get here. There we go. So let's look at some studies done on some trading rules or theories that people have used to try to earn superior returns in the stock market. Contrarian investing. I used to work with a company that believed in contrarian investing. Okay? So what did we look at? Well, we looked at multiples like the PE ratio. And what we tried to do was invest in the stocks of companies that had low PE ratios. Okay? And what we found was, through our studies, that if you buy stocks with low PE ratios, you tend to earn better returns than you do if you buy stocks that have high PE ratios. A low PE ratio implies that investors have subdued or low expectations for a company's fundamentals. Remember that relationship between multiple and growth. If the multiple is low, it means most people believe that the company is not going to experience good growth in the future. And so this creates opportunity for the company and the stock to exceed expectations. Can the company increase their growth rate? Okay? The opposite is true for a company which has a stock with a high PE. Expectations are very high for growth. So if a disappointment happens, it can really hurt the stock price. Look out below if you buy a stock with a high PE. Okay? Dividend yields. Okay? So the dividend yield, the formula for the dividend yield is the annual dollar dividend divided by the current stock price. Okay? Studies show that investing when dividend yields are high generates superior returns on a regular basis. So once again, you are out there looking for stocks that where the stock price has gone down. We'll look at that. Okay? The dividend yields are high because the stock price has declined, but the board has not reduced the dividend. So again, this is contrarian. As the stock price goes down, you become more interested in buying the stock. The board has not cut the dividend. It stays the same. It's in the numerator. But the market price of the stock has gone down, so the denominator gets smaller. So the dividend as a percentage of the stock price is now much higher. This is a high stock dividend yield, and it is a contrarian indicator, and we used to buy stocks that had high dividend yields. Okay? Then we look at bond quality spreads, and we'll look at quality spreads on bonds in the bond chapter. Okay? And we talk about it a little bit in ManFin. When investors fear that the economy will be bad, the yield on lower quality bonds is higher than the yield on higher quality bonds. Okay? What that means is the interest that is paid divided by the market price. If people are worried about the economy, then the market price of poor quality bonds goes down. The interest that is paid stays the same, similar to the high dividend yield, and you have a much higher yield on your low quality bonds. Okay? Investing in low quality bonds at such a time has consistently generated superior returns for bond investors. Okay? So that's another contrarian strategy. Buy low quality bonds when people are worried about the economy and when the yield on these bonds is very high. Okay. Other studies, let's look at earnings surprises. Okay? So the degree, what is an earnings surprise? It is the degree to which actual earnings from a company differ from what most people expect the company to announce. The reasons for the difference and then the guidance regarding what you think will happen in upcoming quarters can affect the future returns of a stock. All these things. What was the magnitude of the surprise? Why did the surprise happen? And what is management telling us about what they expect for the future? All these things will affect stock price. Okay? Some investors look to invest in the stocks of companies that have a trend of positive earnings surprises. And there are research services out there that track the actual earnings versus what was expected. And they'll tell you things like, well, for the last 3 or 4 or 5 or 6 quarters, the company has had an earnings surprise that averaged 7%. Because they've had 6 consecutive earnings surprises, we're going into another earnings announcement. We believe you ought to buy the stock. We believe you ought to buy the stock. Okay, so there are research services that track earnings surprises. Okay. Studies do not indicate that investors can consistently earn superior returns following this approach. So the earnings surprise approach has not worked. The low PE approach has worked. The high dividend yield approach has worked. The high quality, the high spread on low quality bond approach has worked. All right, the January effect. Okay, toward the end of the year, November and December, okay, investors look to manage their capital gains tax liability by trying to match gains and losses on stocks. Okay, you're trying to minimize your tax liability. If they believe some of their stocks are fully valued and that future potential appreciation is limited at this point in time, then investors will sell those stocks and recognize a gain. To minimize the taxes on the gain, they often look for stocks in their portfolio that have losses and which they don't expect to rise over the next 30 days. They're not looking for a quick pop in these stocks, and so they want to offset their gains with these losses. They sell these stocks to realize losses, okay, which they then match up against their gains in order to lower the amount of gains they have to pay taxes on. Okay? The 30-day number is critical because there is an IRS rule that you should be familiar with called the wash sale rule. Okay? This rule prohibits the selling and rebuying of a security within 30 days for the purpose of realizing a capital loss. You can't sell it and then buy it back within 30 days in order to realize a loss for tax purposes. They will ignore that loss. Okay? All right. Therefore, many stocks which are down for the year experience additional selling pressure at the end of the year because those are the stocks that people sell at a loss in order to match up with their gains. It's called tax loss selling. So stocks that have been down tend to get sold out. All right? So what we used to do is we looked for stocks that had been under pressure during the year and that had experienced additional selling pressure toward the end of the year. We looked for these kinds of stocks and we bought those stocks because we knew that most of the investors who sold in November and December would then repurchase those stocks after 30 days had passed. Okay? So people will rebuy the stocks in January and February after the 30-day wash sale is up. And so the stocks got driven down, we would buy them, and then they would bounce back in January, February, and we would sell them, okay? Studies do support this approach, and I can tell you that we used to do it on a pretty regular basis, and we got a nice pop out of a lot of those stocks, okay? But so many people started picking up on this technique, because it was working, that the timing moved from November and December to October or November. All right, we're going to stop there. I think, let me just